everybody. Welcome to Macro Money. This is Ilyas Spivak, head of global macro at tastylive, and we are in for the first big piece of macro event risk early this week. We have the CPI report out of the US that is coming our way. And needless to say, there is all kinds of speculation circling around this release and what it might mean for markets. So we're going to jump right into it, see what this setup looks like, see what's expected, see how it might impact the various asset classes, see what the outcome might be for the number, and how everything might land once it's all over from a tactical and a trading perspective. Let's jump right in. So, looking first at what is expected here. We're looking for a significant, at least from a month-on-month perspective, pickup in inflation, 0.5%. That's up from 0.1 in December. The markets really have been looking for inflation to move at that 0 to 0.1% cadence. A lot of expectations really centered around that view of inflation and the path lower from there to set the stage for the Fed to end its rate hike cycle sometime in and around mid-year and essentially give the markets a bit more of a risk-on sort of tone. Indeed, since essentially mid-October, late October, out to the beginning of November or so, depending on asset class, you've had a risk-on rally, really led by those things that were the most hurt last year against the backdrop of aggressive Fed tightening. Markets very much in a risk-on mode around this idea that inflation has already peaked. A number like 0.5% here on a month-on-month basis would put a bit of a question mark around that idea. Now, for the year-on-year numbers, especially the core, still looking for a shift lower. For the headline, from 6.5 to 6.2%. For the core, that excludes food and energy, which are volatile, and so those can be held back to get the underlying trend in inflation. That seen coming down from 5.7 to 5.5. Now, here is that move lower as relative to market expectations. So the yellow bars there, the 5-year break-even rate. That's the difference between yields on inflation-adjusted and nominal 5-year bonds. I chose 5-year because it roughly approximates the Fed's and most central banks' idea of quote-unquote medium term. They usually target inflation in the medium term, and various central banks have different definitions of this, but the 5-year rate seems to be, give or take, a good benchmark. So looking at this, we see that if we lag CPI, because of course markets are forward-looking, they tend to front-run the economy, and they tend to move ahead of these more lagged indicators that, of course, come with the benefit of hindsight. We have a view that seems to show that right as we were going into the middle of last year, inflation seemed to peak in expectations. You can see that's the peak in those yellow bars right there. And looking at a 3-month lagged CPI number, both headline and core, we can see the peaks were right around there as well. And we've since started to move lower. And you can actually see the differences in underlying versus headline there. You can see that food and energy kind of exaggerate inflation, the moves in the red line a little bit more constrained, the moves in the dark gray one a little bit more pronounced. But something interesting here, you can see that as we look at the most recent yellow bars there, they're starting to edge up a bit. And the most recent one for this month is actually at the highest in about 4 months. So it looks like, although, as you can see on the screen there, we're expected to continue to come in on both headline and on core, 5.5, 6.2 there. Market expectations are starting to sniff out that maybe inflation is a little bit higher than was anticipated. And so maybe there's a degree of life in this yet. And of course, we've heard from Fed Chair Powell extensively that the Fed thinks this is the start, not even the middle, never mind the end of disinflation. Against that backdrop, we can see that after essentially a year of falling, growth expectations, this is from a survey of market watchers by Bloomberg, expectations for economic growth have started to, at least for this year, look a little bit better. Next year, of course, still very much pointed lower and no real signs of life there as yet. But interestingly, even as that outlook continues to dip, the outlook for this year a little bit higher. If we were to put those together, it seems like maybe we have a little bit of a hotter economy this year, which is perhaps inflationary, more so than was anticipated. And then maybe that gets the Fed to hold rates higher for longer. And then maybe that gives us a softer economy next year. So an interesting set of circumstances starting to come together ahead of this CPI report, and not surprising in this context why the market is so laser focused on what this number is going to be. We recall, of course, contextually that the recent weeks in markets, particularly since the beginning of this month, have seen a lot of soul searching from investors. First, we got a Fed announcement, which ostensibly the markets liked. Fed Chair Jerome Powell did not attempt to talk down markets, did not attempt to cool risk sentiment as he did back in December. Instead, he had a fairly laissez-faire, fairly easygoing perspective on recent gains in risk sentiment, which the market actually took as a relatively positive development for overall risk. And then, of course, just days later, a much stronger than expected NFP report. Many more jobs created than anticipated, much better results on the jobless rate. And so we ended up with, suddenly, the market's focused not on the part of the Fed announcement where the Fed chair didn't attempt to talk down markets, but on the part where he said that there are more rate hikes, plural, still ahead, and indeed those comments that the process is getting started. It's not at its middle. It's not at its end. There's a long way to go yet. Looking at how U.S. economic data has performed relative to expectations, we can see, again, a little bit of a perking up recently. So these are surprise indexes that measure the performance of U.S. economic data, realized outcomes, as relative to median forecasts of economists. And those median forecasts can range, but they also do tend to cluster because very few economists want to be the odd one out that's wrong. So a lot of these forecasts tend to come within a kind of range. And so you end up with median expectations that generally, depending on who's aggregating the data, tend to be fairly close. And so looking at that, we can see that both in measurements by city and by Bloomberg, these are different indices attempting to show the same thing, there's been a pickup in the performance of realized data outcomes as relative to expectations recently. We're notably back above the zero line, which means that economists have been betting on softer outcomes than what has actually occurred, which would jive well with this idea that maybe we have a hotter economy. And not a very much hotter economy, but a little bit of a hotter economy this year, and maybe what then the Fed does in response comes at the cost of a softer economy next year. On the flip side, if we restrict the surprise index data, and this we only have from Citi, but if we restrict that data to just inflation data continues to perform relatively negatively. So it tends to generally be slightly above expectation, but you can see the margin by which it has surprised higher has absolutely collapsed. And so increasingly, data is, in terms of realized outcomes, deteriorating relative to forecasts, which would actually put us on the side of an inflation number that might skew close to in line or maybe even softer. At the same time, we remain in contraction mode across the major non-farm sectors of the U.S. economy. We can see the composite PMI index here, and just to remind you all, these work on a logic of 50 being the center line, neither contraction nor expansion. Above 50 is growth. The further you go above 50, the faster the growth. Below 50 is contraction. The further you go below 50, the faster the contraction. We can see here a little bit of a pickup in January, but across services, across manufacturing, and the composite, which joins those two together, we still have a contracting U.S. economy. And so we're still in a space here, better than expected fourth quarter GDP numbers notwithstanding, where economic activity is shrinking. And if economic activity is shrinking, that is the opposite of inflationary. So it is certainly the case that there are some green shoots. We just saw them in the overall surprise indices and GDP expectations. In inflation expectations as they're baked into break-even rates. The flip side is that what we're looking at is a situation where the economy is still shrinking. At least manufacturing and services are still in contractionary territory as based on this PMI data. And as we just looked at, inflation figures, as economists have expected them, have not met expectations. So the models that economists have looked at to generate their forecasts have generally overshot what realized outcomes have been, which of course puts the spotlight directly on the 0.5 month-over-month number. And as I think, well, okay, if it's been undershooting, perhaps it undershoots this as well, and perhaps this is the reason why. We haven't climbed out of contraction territory yet. So, how does all this shake out for the implied Fed rate hikes path? Well, here's the new and updated yield curve. This is as compared to where it was at the beginning of the month, so before that Fed announcement and as it was occurring, and after that announcement, as well as after NFP, and of course after everything that we've seen since. So this is the current curve, and then relative to it, the curve before those two big chunks of evidence in the story. Looking at it here, what we see is, on the one hand, we have rates that are expected to go up a little bit smoother. They're expected to hold a little bit longer at the highs. You can see the top now 6 months from here is the peak, as opposed to 6 months from the beginning of the year. So ostensibly, the peak in rates is now closer to July, August, rather than to, let's call it June, between March and June, which is where the markets thought we were before the start of this month. You can see the peak now well north of 5%. So we're looking at now a peak rate in that 5 to 5.25 range. We then recede a bit by a year from now, and the real cuts come much later. So you can see we still arrive a little bit higher than previously expected, but not much higher, in the vicinity of 3% within a 3-year window. So a slight change, and perhaps even a little bit more hawkish than what the Fed itself was projecting back in December, which is the last time we got their input on this. They were looking for a peak of 5.1%, it seems. And we're now a bit north of that here. So as we look at what this means, maybe a little bit shallower near term, but maybe holding a little bit higher longer term is the upshot. It doesn't appear that dramatic. But when we look at it on a meeting by meeting basis, what we see is a very interesting lack of conviction that has emerged, and a lack of certainty as to where Fed policy is going suddenly. Take a look at, most importantly, this middle column. How much of a standard hike, you can see it at the end there, ARM is the average rate move, so that's what would be the equivalent of one change, one hike or one cut in the Fed rate of 0.25% or 25 basis points. What you see in the center column is what percentage of one hike has been baked in. You can see that for March, one hike is fully baked in. So you have 100%, in this case 104%, or 26 basis points, that's the next column over, has already been baked in. But from there, it's becoming increasingly less certain where the Fed is going. The market was almost fully certain as to where rates would be in May, in June, and thereafter, mere weeks ago. And now there is maybe a 46% conviction for what's going to happen in June, a little bit stronger for May. Thereafter, things start to really get dispersed for the rest of the year. And what this tells us, much more so than the relative conviction of this curve right here, which doesn't seem like anything too dramatic is occurring. When we look at this, what we find is the market is a lot more unsure. And so there's a lot more volatility that is potentially tied into this CPI announcement. And the scenario analysis starts getting a lot more difficult. So if you get a number that's meaningfully softer than expected, you likely leverage risk sentiment. You likely get a situation where you get more conviction in a sooner Fed end of the cycle. You get more conviction in maybe offsetting easing toward the back half of this year, early next year, and you get a supportive environment for stocks, probably a supportive environment to some extent for gold, a very negative environment for the US dollar, lower yields, higher bonds, most likely. As you look at the alternative, let's say you get a meaningfully stronger number, then you get the flip side of that. Stronger dollar, higher yields, weaker stocks, weaker gold as a mix. Gold tends to have the most convincing moves when the dollar, which is a foil for gold, and yields, another foil for gold, are moving in the same direction, whether it's up or it's down. So a stronger CPI number that sends both yields and the dollar higher, likely very negative for gold. A weaker, meaningfully so, number takes us the other way. Where things get murky is what happens if you get a number that's in line with expectations or just off a little bit. So if instead of 0.5, we get something like 0.3, 0.4. And so you get a pace of inflation that's higher than what the market was anticipating and what the recent rally in risk ostensibly is built on. So disinflation is not occurring as fast as people hope, but it's not quite as hot as expectations. And then what the response in that kind of a scenario is that a risk-on response? Because the number is a little bit softer than anticipated and the anticipated one was already baked in? Or is it the other way around? Is it still a number that's higher than the pace that investors want to see and therefore speaks to a Fed that's likely to be more hawkish for longer, and so you get a risk-off response? If you get a number that's right on forecasts, do you get standstill? And what is then the path of least resistance for the subsequent 1 to 2 weeks that we don't have big macro data to feed this narrative? And what, in the absence of those catalysts and in the wake of a CPI number like this, ends up being the path of least resistance for markets? All of these are very tough questions, very difficult to answer. And the reason why, in my opinion, the trading of news releases as discrete catalysts at the time that they come out is exceedingly dangerous. Because one could even know the number ahead of time and still get it wrong as far as the market reaction is concerned. This is, of course, interpretive. It isn't the number itself necessarily that matters. It's the price action in the wake of whatever comes out. There is, however, a bit of a clue that we can see in the asymmetry of market positioning ahead of this. And the lens through which I like to look at it is the US dollar, because it is leveraged to both sides of the story. On the one hand, if the number is higher, we get higher yields, most likely. We get a stronger dollar, most likely, because then the return on holding dollars is higher with those yields. At the same time, that's probably a headwind for risk sentiment and more of an impetus to shift money away from risky assets and to essentially cash out. The cash of choice in that environment is, again, the US dollar as the most liquid and thereby the least volatile. So the dollar is something that sits in reflection of both narratives, the higher yields narrative and the risk-off consequences. And so positioning in the dollar then is a good lens, in my view, of where the market stands ahead of this. So what you see here in the green is net speculative positioning. These are large speculators, so non-commercial net positioning in US dollar futures. This is from the Commitment of Traders report put out by the CFTC. And the red line, or the orange one, rather, is the implied Fed funds rates path for the second half of this year. So July through December, where we until very recently, as you can see, we're looking at cuts of as many as 40 basis points. So come October, you can see we were looking for cuts here. November, we were looking for cuts of between 0.4 and 0.3%, or 40, 30 basis points. So at least one cut if a standard size is 25. You can see those expectations are fading quickly in recent days, and we now don't even have a full cut baked in. We're not out of the woods yet, certainly, but at this point, a full cut is not in there. And we can see that when we lag that speculative positioning, and lagging it is, of course, important because Fed funds futures move in real time. The positioning report is released once a week on Friday, reflecting where the markets were the preceding Tuesday. So it's quite lagged. Lagging it back 23 weeks here, you get some very nice alignment. And you can see that speculative long exposure in the dollar has been reduced just in line with the fading of these rate hike odds. So when you lag it back, the green line and the orange line decline simultaneously. So much of what the market has been doing since October, November, up through now, is pricing in a less hawkish Fed. And that has really been the catalyst behind much of everything. If, in fact, what we are now seeing in the Fed policy outlook curve is what comes next, then perhaps the dollar has room to correct higher. Perhaps it is already offsides. And so the setup here then is perhaps already positioned such that there is an asymmetric risk of a greater move higher for the dollar if CPI gives it that excuse. Then there would be a move lower if CPI were in line or perhaps even a bit softer. And so while we don't know which side of the coin we're going to fall on necessarily, or whether it'll be precariously balancing on its edge, what we can see, it seems, is an asymmetry in where the market stands. And the possibility that in a scenario that's favorable for the dollar, the move might be higher or go further than a scenario that's bad for the dollar, and which would see it weaken. And because the dollar has been a near mirror image reflection of stocks, a near mirror image reflection of overall risk sentiment in recent months, then you end up with a situation where this likewise extends to stocks, likewise extends to markets as a whole. It seems the market is still leaning positioning-wise more so in the risk-on side of things, in the less hawkish Fed side of things, and the greater adjustment is on the flip side of that versus the other way around. So stocks might be more reactive on the downside than the upside. The dollar might be more reactive on the upside than the downside. We are certainly going to be paying very close attention to what happens here and talking about the aftermath. That'll be on Overtime with our good friend Chris Vecchio, head of Futures and Forex here at tastylive. In the meantime, we are done here for today with Macro Money. We'll be back tomorrow to unpick what's next. I am, as ever, Ilya Spivak, head of Global Macro at tastylive. We're here Monday through Thursday every single week. In the intervening time, if you want to hear my various observations, you can catch them on Twitter at Ilya Spivak. Good luck out there, everybody. Happy trading. Speak to you soon.